Hi, everybody. Welcome to the Patty Brennan Show. Whether you have $20 or $20 million, this show is for those of you who want to protect, grow, and use your assets to live your very best lives. Today's podcast is part of the Ask Patty Brennan series. If we get questions on anything, it is about RMDs, required minimum distributions. The laws have changed many times over the past 5 years alone, and it is really complicated. So we're going to boil it down today and really kind of help you understand how they work and make sure that you're not making the mistakes that we've discovered over the years. So first and foremost, what are RMDs? Required minimum distributions have to come out of any kind of a retirement account, including 401ks, 403bs, IRAs. It is really important. The law has changed. It depends on your year of birth. For many people, the first year is age 73. If you are younger and were born after 1960, you don't have to take it out until you're 75. It is a formula-based requirement. The way you calculate it is you have to look at the account value as of 12/31 of the prior year, apply this formula, and then take the money out. Now, here's the way it works. Here's the deal. If you have several IRAs in different custodians, different places, you can do the calculation and take the RMD out of one IRA. That's perfectly fine, okay? However, if you have IRAs, different places, and a 401k, you cannot take out the RMD that's from the 401k that basically include the 401k RMD in your IRA withdrawal. That doesn't cut it. In other words, you have to take them out separately from the IRAs as well as the 401k. Now, 401k plan providers will often, send you the RMD amount, but a lot of times you can't really control which account it's being pulled from. That's a problem because, markets go up, markets go down, and which account are they going to, which fund are they going to pull it from? If the stock market's going through a correction of 20%, you don't want to be selling low. You don't want to be selling when the market's already gone down 20% from that part of your 401k. They typically will prorate the dollar amount. Whereas if it's in your IRA, you can choose where you want to take the distribution from, and by the way, when. You could take it monthly, you could take it quarterly, or you could take it at the beginning of the year and be done with it. So that's first and foremost. Many of you may have received retirement accounts from someone else, a parent. That's called an inherited IRA. Please, please, please don't ever commingle an inherited IRA with your other IRAs because the rules are different. Under the Secure Act 2.0, an inherited IRA must be withdrawn over a period of 10 years. I got to tell you, folks, it was really murky in terms of how you're supposed to pull it out. Do you pull out 1/10 per year? Or can you decide, you know what, we don't really need the money right now. We'll wait until year 6 when we retire. And as long as the account is out by year 10, we're good to go. Well, there have been recent publications that suggest that's not okay, that you should be taking out money from the inherited IRA each and every year. That's the way we're doing it. It's the more conservative approach until we learn differently. So 401ks, they are separate. IRAs can be together. You can take it out of one. 403bs, separate. Inherited IRAs, subject to a whole different set of rules. So just be aware of that. The other question is we have some people who are continuing to work. Hey, I'm happy in my job. I like working. I feel good about it. It's lower pressure, and they continue to work and contribute to the 401k. That is perfectly fine. Actually, there's a neat little loophole that is encouraging people to continue to work. If that is the case, you do not have to take a required minimum distribution out of your employer's 401k. You have to take it out of everything else, but not that particular 401k. So just keep that in mind. No need to pay taxes ahead of time. Let's assume that you also want to do a Roth conversion in the year that you have to take an RMD. Just understand, the RMD must come out first, then you do the conversion. It's kind of weird, these rules. I mean, it feels like sometimes the IRS is trying to trip us all up. What you don't know can really hurt you. So just know, RMD always has to come out first. From a practical perspective, let's say that you've consolidated all of your retirement accounts, you have one IRA, you've applied the proper formula, you know how much has to come out, and you're going to do your tax withholding. Terrific. Let's also assume that you're going to wait till the end of the year to see how you do in your other accounts, in your non-retirement accounts. And let's say it's a really good year and you've got capital gains and taxable income. You can choose to have a higher withholding amount on your RMD so you kind of get the taxes over with. That's a practical tip. We will often calculate out what a person's tax bracket will be. And again, remember, we have a marginal tax system. So just because you might be in a 25% tax bracket, it doesn't mean that 25% of the RMD has to be withheld, because part of it's going to be at 10%, part of it's going to be at 22%, et cetera. But if you want to be conservative and over withhold, this is a system that you can refine year after year. Just please, please, please make sure that you understand what the rules are. Again, IRAs, if they're consolidated, even if you have different IRA accounts, that RMD can be taken out of the one IRA. However, 401ks must be separate, 403bs must be separate, inherited IRAs, whole different ballgame, must come out over a period of 10 years, and always keep that in a separate account. Those are really the highlights of RMDs. We'll go into more details in another podcast, but I just wanted to go over some of the highlights because, again, you probably know this, the penalty for not doing this correctly is confiscatory. Yes, we have a new law. The penalty is not as high as it used to be. I'm telling you guys, it's still pretty high. So please, please, please understand what the rules are. Contact your financial advisor for any clarification. Have them calculate it for you. Thank you so much for joining me today. I am Patty Brennan. We are Key Financial Wealth Management with wisdom and care.